Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's August 2022, and this is the monthly presentation I give about monetary developments. Sometimes I cover a number of countries, sometimes I focus on one. And today I want to focus on the United States of America, which has exemplified some of the rather amazing monetary trends that we've had in the last 2 or so years, 2.5 years now. I pointed out back in spring, summer 2020 that at that time there was a tremendous explosion in money growth in the USA, to some extent other countries, and that this would lead to more inflation, an inflationary boom indeed, and then by implication there would be a boom-bust cycle, busts follow booms, and so this was a sort of fairly typical cycle after a major disturbance to stable money growth. Now, here's the picture that illustrates that. You can see the stability of the ratio of money to GDP in the USA for the 2010s. Then at the very end, particularly that 2020 period, that few months in 2020, burst upwards in the ratio of money to GDP, so that since then we have in effect had a monetary overhang, which is then dominating the evolution of the economy. Now, in January this year, I continued with this analysis and said that we needed to get back to the kind of ratio of money to GDP that we had through the 2010s. We needed a change in the ratio of money to GDP, an increase in a change in velocity of about 22%. 22%. And that could occur through two main patterns, developments. One was the slowdown of money growth, perhaps even a period of no change in the quantity of money or even contraction in the quantity of money, or else a period of rapid inflation, which of course would take up nominal GDP, and then we'd eliminate this excess of money balances, this monetary overhang. And I therefore suggested that the next few quarters in the USA would see buoyant demand, rising inflation, and then probably a recession coming up in 2023. This is a very typical kind of pattern. Now, I want now to discuss all of that and to update the situation. And the first thing to say is that the first half of 2022 was a very strange period. On the numbers, US GDP was lower in the second quarter of 2022 than in the fourth quarter of 2021. And technically, that constitutes a recession. Now, there's no way that the term recession is applicable to what was going on in the American economy in this period. First of all, there was very rapid growth of employment. This is a chart showing the increase in non-farm payrolls in the 7 months to July 2022, comparing it with what was going on in other 6-month periods through the 2010s. And you can see that that last 6-month period has got far more employment growth than anything in the 2010s up until 2019, and then all the disturbances and so on of the COVID period. So this was a period when jobs were readily available, and employment was growing. This is not a recession at all. And in fact, I think a better way to interpret what was going on in the first half of 2022 was that the American economy was hitting its supply constraints. It simply couldn't produce more, and various things happened that of course, so strictly speaking, output actually went down. But actually, the problem wasn't a shortage of demand. It was simply the economy couldn't produce a lot more because it was right up against those supply constraints. Now, so this then came through in the rise in inflation. That's how the excess demand was kind of dealt with. And also, it's quite important to notice this, in a deterioration in the balance of payments. There had been, for some decades, a tendency for American imports to rise faster than American exports. This pattern stabilized after the Great Recession in the 2010s, with net exports being negative by around about 3% of GDP. So that 3% of US domestic demand was being met by foreign suppliers on a fairly consistent basis, and this is relatively stable. Well, that figure moved out in the COVID period to 5% of GDP. It may or may not stabilize there, I don't know. I think there's a recession coming up, it'll probably narrow a bit. But the ability to buy from the rest of the world to meet the buoyant demand in the USA was one of the escape valves for the inflationary boom that followed the COVID period. Well, where do we go from here? I said that getting back to a normal velocity, normal ratio of money to GDP, would require a period of stable money, possibly contracting money balances, as well as rapid inflation. And let's just look at what's happening now to the money numbers. There are various ways you can look at what's happening to the monetary scene. Nowadays, the dominant kind of money in any modern economy is bank deposits. Bank deposits are the main means that we have of making payments, and they're far, far more important, hundreds of times more important than payments by cash as such. And in April, May, June of 2020, I followed the monthly H8 press release, the weekly H8 press release from the Federal Reserve, which had a figure for deposits. There's also one or two other bits and pieces of the quantity of money that matter. An M3 and M2 are somewhat more than deposits. Nevertheless, they're dominated by deposits. And you can see there that huge surge in deposit growth in March, April, May, June 2020, which then prompted me to make these forecasts of an inflationary boom, which have turned out to be correct. Well, you can see at the end, collapse. And if you look at the last, what I've done here is to annualize the rate of change up to the last available data, which is kind of to mid-July. You can see the growth rate. Well, there isn't a growth rate. Basically, bank deposits haven't grown in the USA in the last 6 months. This is part of the adjustment, part of the removal of the monetary overhang. But I won't go through all the detailed numbers now. The ratio of money to GDP is still well above where it was for most of the 2010s. Roughly speaking, we've perhaps eliminated about a quarter to a third of the monetary overhang. There still is more to come. And I think that the correct view to have of the next few quarters is that inflation will stay above 5%, prices catching up with the excess demand in the economy. The growth of output will slow. it looks to me as if the Federal Reserve is keeping a very tight lid on monetary policy, and so this practically end of US money growth may persist for some months, some quarters even, and then we'll get back to the kind of ratio of money to GDP that we had in the 2010s by perhaps the end of 2024. You may say this is a pretty grim outlook. I'm not to blame for that. This is a very typical cycle. It's a very typical cycle. And it's really quite shocking that this cycle should have occurred at all. And as I've said in many of these presentations, the blame lies substantially with the central banks who engineered that big increase in money balances in spring of 2020 and then let it carry on to some extent into 2021. And then in the background, the blame lies with the kind of macroeconomics that is currently fashionable, the kind of economics that pays no attention to the rate of growth or the quantity of money. Having said all that, let me conclude by just pointing out that the business cycle doesn't repeat itself, but it rhymes. And in addition to these monetary developments, we need to look to some extent at what's happening at usual real side indicators, leading indicators for the economy. Now, housing is a very good leading indicator. For most families, the equity they own in their homes is their principal asset. When people move house, there's usually a burst of extra spending because of the spends money on furniture and home improvements and so on. And by the way, when somebody sells a house, he or she receives some money that they then can use for a holiday, a new car, whatever. So you tend to get a relationship between housing transactions and bursts of consumer spending. Obviously, if there's house price inflation, rapid house price inflation, that further stokes the fire of the excess demand. What you can see here is a chart of the sales of existing homes. This is not new homes, this is existing homes. Obviously, such sales are a multiple of sales of new homes because the existing housing stock is so large relative to building of new homes. So fairly steady through, rising a little bit, but fairly steady through the late 2010s. Dip in February, March 2020 as COVID was announced, and then this boom in summer and autumn of 2020 rolling on into 2021 and now turning down sharply. And then let's look at sales of new homes. So this is where we are talking about house building activity, a very volatile part of the economy. And you can see again steady growth through the 2010s, blip upwards, 2020, and now coming off again. So these are classic real side indicators of a cycle. They fit the story. I think what we're going to see is by the fourth quarter of this year, the non-farm payrolls figures really starting to pick up, the slowdown, and then the recession really falling in the first 2 or 3 quarters of 2023. And I would expect US output to fall, say, 3% or so from 2 or 3% from, say, the fourth quarter of 2022 to, say, the third or fourth quarters of next year. Just to, again, put this in context, you can see these fluctuations in home building. This is new home sales going back to 1963, are part of the typical business cycle. There was a very extreme fall after what was defined the Great Recession in the USA. The peak levels of house building were, in fact, in the summer of 2005. And then this collapse from, I think it was about 1.4 million down to about 400,000 in 2009 and 2010. Recovery, another little boom. You see that 2020, we just talked about it, and then falling away. So monetary overhang is still there. It's being worked off. The stability, the stagnation of money is part of that, but the excess demand in the economy is still there for the moment. There will be a recession, and perhaps the economy will be returning to equilibrium by the end, I'd say towards the end of 2024. Thank you.